yet? I hope so. So today we're going to do chapters 11 and 12. In any other textbook, those two chapters would have been married and it would have been one chapter, but not our book. So our book wants us to have the joy of doing 2 DSMs and 2 homework assignments online. Notice that they are due on the same day because as far as I'm concerned, this is one chapter's worth of material. So, chapter 11 by our book is current liabilities. Chapter 12 is long-term liabilities. The difference between current and long-term liabilities is 1 year. If it's due within the year, it's current, and if it's due longer than 1 year, it is long-term. So let's start with current liabilities. So I am hoping that all the liabilities that we've spoken to up until this point, you remember. So I'm not covering those again. I'm not going to do unearned revenue, and I'm going to do one very small notes payable. But these type of things, wages payable, these are things that we've already learned in chapter 4. So I'm going to cover some current liabilities, those things that I owe that are due within the year that we haven't spoken of earlier. So when we did chapter 4, we were thinking about adjusting entries. We hadn't become a merchandiser yet, right? But let's assume I am a merchandiser and I walk into Macy's and you walk into Macy's, you buy a sweater and that sweater is a $100 sweater. What's the chance, as long as you're not, say, in the state of Oregon, what's the chance that you in the state of California get to walk out of that store only paying $100? And the answer is none, right? Because we have state sales tax. And so when a customer comes in our shop and they buy something, I have to collect the sales tax. And as a business, when you pay Macy's that extra sales tax on top of your sweater, you don't think Macy's gets to keep that sales tax money, do you? I mean, the answer is no. They have to turn around and give it to the state of California. There are some states that don't have sales tax. Oregon is one of them. But we don't live in Oregon. So we have to collect sales tax. And while I'm holding it before I give it to California, it's a liability because I owe every dime I've collected of that sales tax to the state of California. And until I pay it, it's a liability. Now, when we talk about this idea of long-term or current, do you actually think California is going to let me hold that after I collect it for more than a year? No. And this is why it's a current liability. So let's look. I know you printed out your selected problems. Let's look at our selected problems and let's look at sales tax and what we're going to have a liability called sales tax payable. It's current because California wants it due within the year. So it says Macy's sold a sweater costing $60 for $100 plus sales tax to a customer. The sales tax in the area is 6% and that was collected as well. Prepare the journal entries necessary for the sale and the remittance to the state government. Assume that as unrealistic as this sounds, this was the only sales that Macy's had before the sales tax was due. Okay. So we know in a perpetual inventory system, I need 2 journal entries to sell something. One is for the cost of goods sold. So on this particular date, I'm going to have a cost of goods sold. And I've got to reduce my inventory merchandise. And this is by the cost of the goods that were sold. But now, I've collected some sales tax, right? 6%. So I'm Macy's, I sold this sweater for $100, I charged 6% sales tax, which is $6. So when the customer pays me, I receive $106. But of course, $6 of them is the sales tax that I owe the state of California. So I'm going to have a sales tax payable for $6. And then the $100 represents the sales that I've had, right? My revenue. Because I am in business to sell things like sweaters. Okay. So it says prepare the journal entry to sell. We did. Now prepare the journal entry to remit this money. So typically throughout the entire period, some companies it's a month, some companies it's a quarter. But for the most part, most companies have to pay monthly. It says now take all the sales tax payable at the end of the month and give it to the state of California. So I increased this liability when I had it, But now that I'm going to give it to the state of California when I remit it at some point, I'm going to take the sales tax payable off of my books for $6. And then I'm going to send the state of California that $6. So sales tax is pretty easy. I collect it. I set up a liability for it, right? And then, actually I set up a liability here. And then when it's time to pay, I just turn around and give it to the state. Easy enough. It's not due more than 1 year. California's not that nice. They want their money immediately almost. So it's always short term. So, let's think about another situation. We said that the measuring stick, right, for current versus long term is 1 year. What happens when we go buy something for which we sign a 5-year note for, or something? We all agree 5 years is more than 1 year. It's a long-term debt. However, sometimes when I sign a note that long, I start making monthly payments. So we said that anything that I pay in the next 12 months, the next year, is current. Yet we all agree that this 5-year note is long-term. So sometimes if I have a long-term debt for which I'm making regular payments on, the payments that are due in the next 12 months are considered the current portion of that long-term debt, and then the rest of it is considered to be long-term debt. So we are now on our balance sheet, in a classified balance sheet, going to split that debt up into 2 pieces. So let's look at selected problems number 2. We purchased a utility vehicle on May 1st, year 1, for its manufacturing facility. It cost $36,000 and we signed a 36-month note, okay? And we got a 0-interest loan. Yay! Okay, so if it's $36,000, it's 36 months. Do you agree I should be paying $1,000 a month? And we bought this in May of this year, May year 1. And I started making payments, right, on June 1, 30 days after I bought the vehicle. So it says, at December 31st, year 1, how much of a loan related to this purchase will be classified as current and how much of it will be classified as long-term? Okay, let's think about this. Let's erase this first. So, May 1, year 1, I purchased a vehicle that cost me $36,000. And at that time, I'm going to pay over 3 years. 3 years is definitely longer than 1 year. So this is a long-term debt. No doubt about it. But then I made $1,000 payments each month starting June 1 in year 1. And now it's asking me about December 31st, year 1. We need to be very careful with our dates here. So I made a payment June 1. I also made a payment on July 1. Then August 1, September 1, October 1st, November 1st, and December 1st. So by the time I get to December 31st of this year, I have made 1, 2, 3, 4, 5, 6, 7 payments of $1,000. So liabilities mean I owe someone money, and if I've made those payments, I owe nobody. So the original debt was $36,000. I have paid $7,000, and so currently the total amount of this debt is $29,000. And my question to you is, how much of this will be recorded as current, and how much of it will be recorded as long-term on our balance sheet? Well, any payments due in the next 12 months are current. So if I make a payment of $1,000 a month for the next 12 months, that $12,000 will be considered current. And we will show it as the current portion of long-term debt on my balance sheet. The remainder, $17,000, will be shown under long-term liabilities, long-term debt. So even though the entire debt is classified as long-term debt, on our balance sheet, because I'm going to make payments in the next 12 months, all the payments that I have in the next 12 months will be considered current. The current portion of long-term debt, which I will show in my current liabilities. And then we have this idea of the remainder being long-term debt. I'd ask if you have any questions, but you can't ask on this film. But you could send me an email, right? Okay, so current portion, long-term debt. Sales tax payable, also current liabilities. And now we're going to go into something that a lot of us know a little bit about. How many of us have had a job before? The one where we didn't get paid under the table. You know, the real jobs. Okay, no, even the ones under the table are paid. They're real. But nevertheless, the ones that are legal, let's say. If you work for $10 an hour and you make $10 an hour and you work 40 hours this week, you and I know that we don't take $400 home with us. $400 is our gross pay, but it's not our net pay. And I, your employer, let's pretend, I am required to withhold certain things out of your paycheck. You may voluntarily allow me to withhold other things, maybe like 401k and medical health insurance, but there are some things you don't have a choice of, right? And I take those out whether you like it or not. Okay? So some of the mandatory things that I am required to hold out of your paycheck, depending on what you tell me when you're hired, is federal tax. That's required everywhere. State tax, if we live in a state that actually has income tax, and you say, not all states do? Hell no. California is the most taxed state in the United States, close to New York, okay? We tax everything. We tax your income, we tax your cars, we tax your house, we tax the things that you buy at the store. We tax it all, right? But some states, they all need to earn tax money so that they can build roads and pay their police officers and their fire departments and such, but they find different ways to do it. And so, say, state of Washington, Nevada, Texas, Florida, Tennessee, among others, they don't have an income tax, right? They don't tax their residents for working, right? But California does, and California taxes everything. But all these states have inventive ways to collect money for taxes. And let's just take Florida, for example. What does Florida have a lot of? It's got two things that they've got a lot of, and they don't have a state income tax, right? They don't tax the employees that work they still tax people, but they don't tax them on their income for working. Florida has got a lot of old people, right? They all run down to Florida to retire. So there was no point if a lot of our residents, or a lot of Florida's residents, don't even work. Income tax wasn't going to bring a lot of money in. Florida figured this out very quickly. So it said, okay, so we won't have that. But what else do they have a lot of? Think. Yeah, they have a lot of insects and roaches too. But they have a lot of tourism. And so they got ingenious, and they decided they would try and raise a lot of money from the people that visit the state of Florida, and that they would try and get the majority of their tax revenue, or a lot of it, from tourists. So hotel occupancy fees are very high. Sales tax on things like meals are actually very high. And so they try and collect a lot of tax revenue from tourists. But they also have extraordinarily high property tax. So I figured that all those old people that moved down there that weren't going to work, they were still going to buy a nice place to live. And so they're still getting some tax money from those people. Right? Even for the part-year winter birds, right, that only come down in summer that own something, they are either renting it, and so the state of Florida is getting a high occupancy tax, or they bought something, and even though they don't live there year-round, the state of Florida is collecting a high property tax for it. So Florida has worked a way around of not having, say, income tax, but it taxes other things. We in California, we just tax everything. And so certainly income is part of it. So if I am an employer in a state that has state income tax, I'm required to hold that out of your check. Everybody has to pay into the federal system. And then I'm also required to withhold something that we call FICA, which is two pieces, Social Security and Medicare. So together, we call that FICA, and I'm required to hold that from your check as well. So let me ask you a question. You and your colleague, you're the same, right? You come to work, you earn $10 an hour, and you worked 40 hours this week. The only difference between the two of you is one of you is single, one of you is married. All other things equal, who will I take out more federal and state taxes on? The single person, right? It's not all equal, right? It's based on if you tell me whether you're married or not, or how many kids you have, right? And in fact, the more kids you have, let's say you're both single for all practical purposes, but one of you says you have a bunch of dependents and the other tells me you have none, I take out more on you single with no dependents, right? So I have to calculate for each employee a state tax amount, even if you make the same amount of money. You each made $400, right? Each of you will have different withholdings, right? Different amounts withheld for both federal and state, depending on how you tell me you are, whether you're married, not married, kids, lots of kids, whatever, right? So payroll in and of itself is just an ugly thing because nobody's all the same, right? And then, there's the Social Security and Medicare. Those are flat rates. Right now we talk about some stimulus package and these things that are happening now because of the virus. But in general, it is a flat rate. For Social Security, I take out 6.2% of your check. For Medicare, I take out 1.45%. And not only that, I take that out of your check, but I am required to also match it. So if I take out $50 out of your paycheck this period for Social Security and Medicare, I have to also reach into my pocket and take out another $50 and match your $50 and send it in with your $50. So all of those things that I've withheld, right, your federal tax, your state tax, your Social Security, Medicare, while I'm holding it before I give it to the state of California or the federal government or Social Security or Medicare, they are current liabilities because I assure you none of those governmental agencies will let me hold that money for more than 1 year after I've taken it out of your paycheck to give it to the right taxing agency. In addition to those things that I'm required to hold out of your check, you may voluntarily allow me to withhold other things, such as if I happen to have a health insurance plan of which we each contribute to. If you decide you want it and you pay the $100, then maybe I match it $100 or something like that. Maybe you donate to United Way. We have some type of donation plan, whereas I take it out of your check and I give it to United Way. It might be that you contribute a part of your salary for your 401k. Those are all voluntary. And at that point, by the same token, if I withdraw those out of your check before giving you your check, those are also current liabilities for me because I owe the 401k company or the insurance company or United Way the money that I took out of your check. I don't get to keep it as your employer. So let's look at an example, basic. Again, select your problems, and let's look at number 3. It says we have 3 employees that each worked 40 hours a week and made $10 an hour. Assume that federal taxes are withheld at 10%, state taxes at 8%, Social Security are 6.2%, and Medicare is 1.45%. Now notice in the problem it says up to $118,500 for Social Security. This selected problems is a few years old. These days it's approximately getting closer to $130,000. But for the first $118,500, or now this year, close to $130,000, I am required to take the 6.2 out of your check and 6.2 out of my pocket to match. But once you reach this threshold, then I don't have to withhold out of you and I don't have to match. But we have to be a high-paying employee for this. In essence, you have to make over $60 an hour to ever cap out at this, right, near the end of the year. And so then it changes over when the calendar year changes, it starts back at 0 again. So on average, only highly paid employees usually ever exceed the Social Security cap. Okay, so let's look at this problem. The first thing it's asking us is what is the net pay for one employee? Now clearly I have 3 employees, but let's look at net pay. So we know gross pay will work better, and you can see it better if my pen wrote darker. So let's get a different color. This employee worked 40 hours this week. We paid $10 an hour. Gross pay, $400. We said, let's pretend that federal tax is 10%. So I want to say FIT, federal income tax. So 400 times 10%, we're going to subtract out $40. Then there's SIP. What do we think that equals? State income tax. That's 8%, they said. Then we've got, I just have SS, Social Security. It is 6.2%, right, of your gross pay up into a certain amount. Well, I can assure you at $10 an hour, you are never going to cap out. I don't care how many overtime hours you put in. There's not enough in the year. And it tells us this is the first pay period of the year, so I'm required to withhold it. So $24.80, and then there's Medicare. So this is 1.45%. Wow. This is $5.80. Okay. So, we've taken out those things that are required. Federal, state, Social Security, Medicare. And then it says, further assume that FUTA standing for Federal Unemployment Tax, and SUTA, State Unemployment Tax, are 0.5 and 5.4% on the first $7,000 of wages. Since this is the first pay period of the year, this would be the first $7,000. But you know what? I don't take that out of your paycheck. That's something that I, as your employer, is another cost for me to keep you legally employed, is that I have to pay this on you. So we're temporarily going to ignore this piece of information because I don't withhold this out of your paycheck. Okay? And then it tells me that insurance premiums are $100 a week. The employer pays 60% and the employees each have insurance and they each pay the 40% of their share of the premiums. So, if health insurance is $100 and they pay employees 40%, that's $40 a week. So I'm going to take this out of the employee's paycheck, and at this point, assuming that we don't have anything else, 401k, you have no garnishments or anything like that, then if I net this out, this should be our net pay. It looks like it's $257.40. Okay. My pen is dying quickly, and some of these are brand spanking new. That's very sad. Okay. That one looks dark enough. So then the next question says, we'll prepare the journal entry for employees to pay them for the 1 week. So this is net for one employee, but now I have 3 employees. Okay, so I need to prepare a journal entry, and I need the space that this is in. So I'm going to erase this, but I need us to remember it. So we're going to take a break while I erase the board, and then we're going to do the journal entry that is associated with this. Okay. So, in that 2-second break, I erased the board because I need this space, but I did a little bit of math. I moved over this gross pay to net pay for one employee. I multiplied it times 3. Remember, we have 3 employees. And I went ahead because they told us FUTA, federal unemployment, SUTA, state unemployment, were this 0.5%. Be very careful. The decimal formatting for 0.5% is 0.005, right? And then the 5.4 for SUTA, and I calculated the amount that's going to come out of my pocket. So the first part says, prepare the journal entry for paying the employees. So I have first fee, wage expense, and the gross pay is $1,200. But in the meantime, we all know that I only gave them cash of $257.40 each, right? So that's going to be cash times 3. But all these dollars that I withheld times 3, right, for the 3 employees, these are all liabilities. So I withheld $40 from each employee, all right? $120 federal. I'm going to have FIT payable. $120. I'm going to have SIT payable. Current liabilities, $96. I'm going to have Social Security payable, which your book may combine with Medicare to be FICA payable. I like to separate them out myself. And so I'm bringing all these over, and then I've got insurance payable, but I've got to give the insurance company that I held out of your checks $120. And then there's this idea of cash. I wrote you all, you 3 employees of mine, 3 individual checks for $257.40. Okay. Now, then it says C. Prepare the journal entry for payroll tax. This is the taxes I pay above and beyond the $1,200 that I expended for you, right? And I took some taxes out of your check to send. But now I have taxes of my own. I am required to match your Social Security, your Medicare, and then I'm required to pay into FUTA and SUTA, the state and federal unemployment system, right, amounts up for the first $7,000 that each employee earns. So at the beginning of the year, I start putting into the system. Notice the state system gets more than the federal system. The federal system oversees the entire process. But it's the state systems that actually have to pay out. Okay? And sadly, even though I put in this period $64.80 to the state of California, this is not earmarked for my employees. All right? The way unemployment works is that every employer puts into the system, and then every employee that needs it can pull out. And it's not just for my employees. It's for all employees. All right? And typically states have an experiential rating, which is to say that if I lay off employees more than everybody else, then my rate is higher. And if I lay off employees less, my rate should be less to put into the system. Right? So, but it appears that I have to put in $64.80. And I only do that for the first $7,000 that you earn. After that, for the rest of the year, I'm pretty good. I don't have to pay in. Unless you quit, of course, then I have to hire somebody new, because then that new person starts their $7,000 again. But at the calendar year change in January 1st, then I have to start paying again to everybody. And remember, it told us this was our first pay period. Okay, so my payroll taxes, I have to match this $74, this $17, then I have these 2 and this 2. So I have a payroll tax expense. It's going to equal all of these together. And so one of them is Social Security payable, which we know I match yours, $74.40. One is this Medicare payable, which I match yours, $17.40. And then I've got this FUTA payable, $6. And then this SUTA payable, which is $64.80 this week. And then, and all my debits have to equal all my credits, so I'm going to add these up. 74.4 plus 17.4 plus 6 plus 64.8, and get 162.60. So So that's above and beyond the $1,200 that I paid you. Then it says, well, you know that insurance? I withheld 40% out of your check, but remember I'm paying 60%, and all three of you have gotten the insurance. So my benefit expense this period, and that is benefits, right? That the insurance company that comes out of my pocket above and beyond the $1,200, above and beyond everything else, right? Is that I have a benefits expense. So it was $100 a week for that insurance. You, the employee, agreed to pay 40%. I paid 60%. So 60% of $100 is $60. I have three of you all. It's going to be $180. And then I have insurance payable. Because I've got to give Blue Cross or Blue Shield, whoever is hosting our insurance, the money as well for the premium. So not only did I pay you $10 an hour for the 40 hours out of my pocket, then I had to match your Social Security, Medicare, right? Then pay into the unemployment system, and then I matched a part of your insurance cost. If we have a 401k, then there's that cost as well, and if we have a pension, we also have that cost. But we're going to keep this problem simple. So then it says, you've prepared payroll. Great, I did for this week. Not only do I keep this record in total, I have to keep it individually for each of you, all right? Because at the end of the year, I'm required to give you a W-2 form so that you can file it with the federal government. So record keeping for taxes, payroll taxes, is daunting. In fact, it's awful. I love accounting, and I hate payroll, all right? Not only that, they're usually due quarterly, so usually it's the calendar quarters, so right at the first week of April, first 3 business days. So if Easter comes early, you're screwed there. I assure you that when you file on the second quarter, which is July 1st, the first 3 business days, you don't get July 4th off. The only day you're halfway safe of not missing a holiday filing these taxes is third quarter in September, meaning the first few days of October. And then when you come into January to clear out fourth quarter, it's New Year's, and you're going to be at the office doing payroll. It's awful. Never do payroll. But we still have to learn a little bit about it. So it says, what if you were going to remit these taxes, right? Because I make this entry every week for these employees, and then I keep it in total, but I have to keep it for each 3 of you so that I can tell you at the end of the year what I withheld out in taxes and all these other things. But then I also have to pay this money to the government because, again, it's a liability, right? It's a current liability. I owe them within the year. And I assure you, some companies, if they're large enough, their payroll is large enough, it is monthly. But for this company, it's going to be quarterly. So now it says the last is, will you remit? Assume you remit them all at the same time, and we can do that, okay? So I'm going to erase this, right, and I'm going to put the remittance entry here. So we've got B, C, D, E. Let's remit this. So I'm going to take all these liabilities off my book and send, it looks like one check, but of course it will be multiple checks to different taxing entities. So let's take the federal tax off the books first. It's 120. Let's take the state tax off the books. Let's take everything off the books. Let's pay it all at one time. Now be careful here. When I get to Social Security, I have taken it out on your side, but I've also taken it out on mine. So when I go to pay it, I've got $74.40 times 2. That gives me the $176.40. The same is true of Medicare. I took out $17.40 from your check, $17.40 out of my pocket. So when I give it, I got to give both. $34.80. And then also, same true with insurance payable. I took out $120 from you. Then there was $180 from me. All $300 will go to the insurance company. Then I've got FUTA and SUTA payable. So it looks like 6 and 64.80. And at that point, I've got all the liabilities. I'm going to send a check. Let's wipe it off our books. All right, I want to credit cash. So let's add these up. And I get a number. It looks like $798. Okay, so now we have sent these taxes off. But, you know what? My math is wrong. That's unfortunate. How is my math wrong? I'm looking at it. You know what? If I take 74.40, my calculator must be having PMS today, just like me. Okay, 78.40, and I multiply it times 2. I'm not going to get 176. I'm going to get 148.80. You know the whiteboard makes this very easy for me. I bet if you're writing in ink, you hate me right now. But it's okay. Let's re-add these up. Yes, this is a better number. How about 770.40? And this is what I'm going to end up writing my check to all the institutions for. Okay. I mean, if I didn't mess up every day, at least somewhere, y'all would be like confused. You wouldn't know what to do with yourselves. Okay. So I would like us to skip over some selected problems, and we are going to do one that fits with these before I start with contingent liabilities, because I love contingent liabilities. So let's get this notes payable, number 7, done first, and then we'll go back and pick up 4, 5, 6, 8, and the rest of them. But 7 goes along with these well. Okay, so I am going to erase the board, and when we come back, it's going to be clear, and we're going to start again. So looking at number 7, we've got a notes payable. This is going to work very much like a notes receivable. And we took this note on December 1st. It's a 120-day note, 12%, $10,000 we borrowed. And it is not a leap year. First things first, I want to calculate maturity date and maturity value. And then I want to make journal entries for this note from start to finish. So, it's a day note. I got to count physical days. Don't tell me you've forgotten how many days are in every month since we did this in chapter 8. Okay, so December has 31 days. I took this on the first day. So during December, I've accounted for this note for 30 days because the first day of the note doesn't count. Then we've got January. How many days does January have? 31. It's a 120-day note. I'm not close. Let's go to February. This is not a leap year, we're told. But if I pick up another month, there's a good chance I'm going to exceed my 120 days. So I'm going to stop here. Okay. So I've got 9, and then I've got, let's see, 6, 7, 8. Okay. So if I take 120 days and subtract out 89 days, well, if my calculator would be 80, I get 31 days. So we need 120 days. And March happens to have 31 days. So I take the 120 days, subtract out the 89 I've accounted for. This gives me 31 days, so December, January, February, March. So the maturity date for this note is March 31st. Let's calculate maturity value. So maturity value is going to equal the principal plus interest. Let's calculate our interest. we're going to take the $10,000, multiply by the annual interest rate of 12%, and then even though your book is awful and uses 365 days in the year, we are going to use a banker's year of 360. So I'm going to take my 120 days over 360 days in a banker year. So 10,000 times 12% times 120 over 360. I have interest of 400. So when I calculate maturity value, I've got $10,000 plus interest of 400. Maturity value is going to be $10,400. Okay. Now, it says record this note from beginning to end. Right? So I borrowed this money. Right? So on December 1st, when I get the note, when I get the money, I debit cash. Yay, 10,000. And I credit notes payable. 10,000. And if life were really nice, we would not cross over a year in, and I would just fast forward to the maturity date, recognize that I've got to pay $10,400, and that I've had $400 of interest. But we didn't get that lucky. We cross over a year in. So I need to make an adjusting entry. Even though no cash will change hands, I need to make an adjusting entry at December 31st. I have incurred an interest expense, and I owe somebody interest payable. And I have now incurred this for 30 days, from the inception of the note to the last day of the year. So I need to calculate 30 days of interest. Granted, I calculated 120 over here, but 30 days interest, this pen doesn't look dark enough, let's see. 30 days worth of interest is going to be the $10,000 times the 12% times 30 over 360. And if I do that, 10,000 times 12% times 30 over 360, I'm going to get $100 of interest. So my interest expense from December 1st to December 31st is $100. Now granted, I'm not going to pay that money until maturity, but I need to recognize that I've incurred an expense for my records as of year end. Then I get to March 31st. And I need to pay maturity value. I need to pay this $10,400 back. So if I pay them back, I have this liability of notes payable on my books sitting out here at $10,000. I get to take it off my books. I also said I had some interest payable at the end of the year for $100. I have to take that off my books. But we all know that I have to give them cash of $10,400 because this is maturity value. So what is the other $300? Because we know our debits have to equal our credits. Our other $300 is that this is the interest expense for this period, right? This is for all of January, February, and March, which, by the way, is the 90 days. We had 30 last year. So if I take the $10,000, multiply by 12%, multiply by 90 over 360, this will get me $300. We knew the total amount was $400. We knew that when we calculated it here. It's just that some I have to show this interest expense of $100 up here, and last year, the rest, $300 this year. So this works no different than our notes receivable. It's just in reverse, right? Instead of me getting paid, I'm the one that borrowed the money and owes it. So from here, we are going to go to contingent liabilities. One of my favorite topics. Okay, go get your coffee, come back, we'll be ready for contingent liabilities. So, contingent liabilities. Liability means I owe somebody, and typically, it's usually a finite amount. I know whether I owe somebody or not. I usually know how much I owe them. But on occasion, we get to the end of the year, or the end of the accounting period, and there is a chance I might owe someone money. But I really don't know definitively at the end of the year whether I do or not. And so I asked myself, should I tell my users of the financial statements? Like, when do I let them know? And so we decided that we would ask ourselves a question. How likely is it that I will actually have to pay in the future? And we have three choices. It's probable I'm going to have to pay. It's possible I'm going to have to pay. Or it is remote that I am going to have to pay. Now, if it is deemed remote that I will actually owe anything, I do nothing. I'll let it go. I don't even mention it. If it's possible I could owe, then I footnote it in the financial statement. Dear readers of our financial statements, we have currently been served with a lawsuit, but we do not know the outcome until we go to court. So at the end of the year, there's a possibility, right? I've been served with a lawsuit notice, so I know that there's a possibility I may have to pay in the future related to this, but I don't know until I go to court, right? So I asked myself, well, do you think I'm going to end up paying? And if the idea is that no, it's possible, but we don't know, then I just footnote it in the financial statement. So I say I'm involved in, 6 lawsuits at the moment, and legal counsel has determined that they do not know the outcome. So typically lawsuits are contingent liability. There's a very common contingent liability. Right? But let's assume that it's probable that I'll owe it, but I still don't know this for a fact until we go to court, right? Then I have to ask myself, can I estimate the amount? If the answer is yes, then I make a journal entry and I actually book the liability. But if I can't make an estimate, then I footnote it. Because of course to make a journal entry, I have to have an amount. All journal entries have an amount, right? So if I don't know the amount, I can't make a journal entry for it. So let's take some examples. Let's look at number 4. Okay. So, here we go. Vaughn Company was served notice that, I'll sit up here, I'll probably fall. Let's see. That a customer was suing them for allowing alien abductions to occur on his premises. The customer is requesting $1 million in damages. This notice was received prior to year end, but no legal action can occur before year end. Legal counsel has decided that it is remote that Vaughn will be liable for any damages. How should this lawsuit be handled in relation to the liability section of the balance sheet? Well, if legal counsel says it is remote, I'll do nothing. I'm like, yeah, okay. Well, we're a truly litigious society. We get lawsuits. You would be surprised how many lawsuits businesses get that are quite frivolous. And if it's deemed that there's no chance likely that we'll lose money, well then I do nothing. But let's go to the next problem. Dr. Webb, ND, entered the operating room while under the influence of illicit drugs and promptly amputated the incorrect leg, even though the operating room staff tried to stop Dr. Webb. The patient is suing Dr. Webb for damages, and at year end the case has not been settled. So we have a few scenarios. A says, assume the lawsuit is seeking $5 million and that the hospital's legal counsel feels the patient will prevail in court. Prepare the journal entry necessary, if any. Well, yeah, at this point it's probable, right? And we know an amount. So as soon as it's probable and I know an amount, then I book it. All right, I'm not going to get up and write this on the board, but we meet the level where I should put it on the books. I would debit lawsuit payable, $5 million, and then I should credit lawsuit payable, the liability, right, for the $5 million. And you say, but Professor Vaughn, he has malpractice insurance. I bet he does have malpractice insurance. This is one of those long ago lawsuits with GAAP, and GAAP said it doesn't matter that they have malpractice insurance, and it doesn't matter that the malpractice insurance may pay. At the moment, right now, you've met the qualification of booking this liability. You book the $5 million to an expense and to a liability. And if and when in the future period that your malpractice insurance does pay, then you can reverse the expense off your books and then have it cover the payment to the client or the patient. But up until it goes to court, you are assured that you are going to lose the money because the court settles with the patient, right, or settles on behalf of the patient, and you have to pay and malpractice pays, then, that's the only time you can file it with the malpractice insurance is after you've truly lost the case, and then it's still up to them whether they're going to pay you or not. So at this point where it hasn't gone to court yet, you have to book the whole thing, regardless of what insurance you may or may not have. B says the lawsuit is asking the court for damages for pain and suffering and is asking the jury to, quote, award an amount that is appropriate for such a loss. Prepare the journal entry if any. So here we go. We're sure that we're going to lose. But the moment that the patient asked for the jury to come up with an amount, well, it depends where this jury is. If this jury is in California, it's probably going to be a very large amount. But if this jury is somewhere else, it might not be as large. So, yes, it's probable, but can I estimate the amount that a jury of 12 people of my doctor's peers would place on that? I can't even come up with an estimate. So in this situation, we would footnote it. If we go back through history and we look at 9/11, which happened in September, if a lot of the companies associated that had massive losses had year ends of December 31st, such as some of the airline companies, those planes went down, people died. Don't ever doubt that those families didn't sue. But as of 12/31, the airline, you have like a year and a half to decide whether you're going to file a lawsuit or not. At the first December 31st, the airline didn't have any idea how many lawsuits it might be involved in, but it knew it was probably going to have to pay. It knew, right, that it was going to cost them a lot of money, but they couldn't begin to fathom even how many tens of millions. In that case, they footnote that 9/11 has happened, that there are lawsuits involved with it, but that they have no estimate. Because to prepare a journal entry, you have to actually have an estimate. So in this case, because juries can award such a wild range on the spectrum, we just footnoted. Let's go on to see. These were all independent assumptions. It says, assume that unlike the original premise, Dr. Webb was not under the influence of anything at the time of surgery, but still amputated the wrong leg because the patient had marked his own leg incorrectly as a prank to see if the doctor was paying attention. Legal counsel has noted this patient has sued 4 other doctors in the recent past with similar misinformation. They think the jury might believe that the patient was to some degree responsible for his own misfortune, and that the doctor may be spared paying damages. But no conclusions can be known for sure until trial. Prepare the entry if necessary. So in this case, right, we did amputate the wrong leg. But now we have a reason to believe that we could convince a jury that the patient might have, been to some extent their own worst enemy. And so there's possible that we might not have to pay. In that case, we're at the possible part. And possible says you footnote it. So are there things that are contingent liabilities besides lawsuits? Sure. How many of us have ever used a coupon before? I love coupons. I go through the Sunday paper and I clip them. So my favorite cereal is Frosted Flakes, by far. So there's a $1 coupon in the paper. I clip that coupon. It has an expiration date. And I go to the grocery store and I put Frosted Flakes on the counter and I put my coupon on the counter and I save $1. Right? Do you think the grocery store is out of $1 or Kellogg's or General Mills? I think they're Kellogg's. Or is Kellogg's out of the $1, whoever made the cereal? And it's whoever made the cereal, let's pretend it's Kellogg's. Right, so what the grocery store does is they turn around, they send that $1 coupon to Kellogg's, and then Kellogg's sends them $1. The store is not out the $1. The people that make Frosted Flakes are. So let's assume it's near year end, and you just ran a Sunday circular and you got a whole bunch of coupons out there that haven't expired. what is the chance that absolutely no one will redeem a coupon? It's zero. There's people like me that cut coupons every single day. So it's probable, right, that those coupons are going to be redeemed and that Kellogg's owes some of the grocery stores that are going to accept these coupons many, many dollars. So then it comes down to, can you estimate your coupon redemption? And believe it or not, a lot of these companies can. Companies that put coupons in the paper section over and over routinely, they know exactly approximately how many will be redeemed. So if they can make an estimate of the amount of coupons that will be redeemed, then yes, they have a contingent liability that is probable that they can estimate, and they should put it on their books. Ever bought a product with a warranty? Your cell phone, your computer? What's the chance that nobody will return something within the warranty period for work? Zero. I tell you, people will break it and then try and submit it for warranty, even though it wasn't your fault, right? But if we offer a warranty, that also comes down to a contingent liability, because there's a chance, especially if it's a 3-year, 36,000-mile warranty like on my car, there's a chance in the next 3 years and 36,000 miles that I might file a warranty claim with Nissan or whoever I bought my car from. So it's probable that at least one customer of everybody that bought a Nissan this year will file a warranty claim. Now, it's just a matter of, can you estimate? And if you can estimate that contingent liability, because it becomes contingent upon whether the customer brings the car in or not, then you have to book an estimate. And I assure you, automakers, your cell phone makers, anybody that has a fairly liberal warranty can estimate the amount of percentage and dollar amount that the average customer puts under warranty. So we are going to do 2 problems. So we have looked at together problem 4, but let's do problem 5 and 6, which are, maybe it's 7, yes, 7 and 9, because we did the notes payable in the middle. So 6 and 8, sorry. Let's do number 6 with the Kellogg's, and then let's do Ezekiel and look at their warranties. Okay, so looking at number 6, we have Kellogg's. They printed $1 million or $1,001 coupons in the Sunday, December 15th paper. These coupons expire January 31st. This is the only coupon that is not expired by year's end, and in the past, 40% of circulated coupons are redeemed. As of December 31st, 150,000 have already been redeemed. Prepare the necessary journal entry if needed at year end. Well, it's probable that they're going to redeem coupons, our customers, and we can estimate the amount, 40%. So if it's probable, and if I can estimate it, then yes, I am going to book this liability. So, we've got 1 million coupons, each $1. I am potentially on the hook for $1 million to grocery stores. Okay? And we know that 40% generally are redeemed. So now I'm really thinking that my estimate for all these coupons is 400,000. But by year end, some of the customers have already redeemed them. 150,000 of them have been redeemed. So I'm thinking that really I'm only on the hook for 250,000. At that point, I might put coupon expense, 250,000, coupon payable, 250,000. And the liability, of course, is this coupon payable. Coupon expense might actually just be considered marketing expense. A lot of companies consider this coupon to be a marketing expense. Questions? Ha! I know you can't ask, but you could always email me. So let's look at, so we already did number 7 in between. Let's look at Ezekiel number 8. This is the warranty one. Ezekiel sold 500 whatchamacallits during 2018 at $4,000 each. During 2018, Ezekiel spent $20,000 servicing the 2-year warranties that accompanied the whatchamacallits. all applicable transactions are on a cash basis. So it says, A, prepare the 2018s for Ezekiel using the warranty expense approach. Assume that Ezekiel estimates the total cost of servicing the warranties to be $150,000 over the 2-year period. Okay, so let's look at the journal entries. At some point, do we have cost of goods sold? Yes, we do. When I sold these, they each cost me $4,000. No, I sold them for $4,000. We don't have a cost of goods sold, so let's ignore cost of goods sold. So at some point, I debited, let's assume they're all cash transactions. So $4,000, I sold them each, and I sold 500. So I've got $2 million in sales. Now there's a 2-year warranty on these, and they're saying that they estimate $150,000 will cover all the years of the warranties. But during the year, before I even get to year end, to get to this point of a contingent liability, I've actually had to repair $20,000 worth. Now normally, we wouldn't say this is a cash transaction. So during the year, right, I would debit warranty expense, the $20,000, and normally I would be crediting something like wages payable, parts, labor, right? Because that's usually what I have to do. I have to fix some part or supplement some part, right? And it requires my labor to do that. But for the moment, it just said make them all cash. And then we get to the end of 2018. And we've estimated that it's going to be $150,000 for both years. And this year I've already spent $20,000. So I'm still thinking I'm on the hook for a potential of $130,000 to service these warranties. So at this point, it's probable, and I can estimate the amount of this contingent liability, so I'm going to put in the warranty expense. And then warranty payable. And the warranty payable, of course, is my contingent liability. Because I really don't know until a customer brings it back to me whether I will end up having to fix it or not. So we've got this warranty payable on the books. And then it says in 2019, we actually spent $130,000 to fix things that we sold in 2018. It was very convenient that it turned out to be exact. In real life, it likely isn't. And so we just have some extra left over in the account. Don't worry about that. Pretend that life is good. So now we're in 2019, and during 2019, I end up spending $130,000 to fix these guys from 2018. Then at that point, I take it out of the warranty payable and credit cash. But usually, like I said, this will be parts and labor. The reason that we want to put this liability in with this year is we want to match the liability for all future years with the sales that we have. We match our revenue and our expenses together. So I don't take it out as an expense in future years, right? I want to match, because I don't have that revenue in future years from 2018. So the warranty approach has us match our revenues and expenses quite well. Another thing that could be considered a contingent liability is bonuses. When we pay our employees a bonus, I know that a lot of companies have a structure, which is to say if net income falls in some range, you'll get 10% of your salary as a bonus, a year-end bonus. Or if gross profit is such and such percentage, in these range, you'll get some type of bonus. So until the end of the year, until net income is actually calculated, for which the year has to be ended, at the end of the year, there is a potential that we might owe somebody or our employees for a bonus depending on how we've structured the bonus setup. In which case, I might need to put a contingent liability on the books if it is probable that we will meet this net income or gross profit limit. And then multiply right by the amount of the bonus. So I'm going to erase the board, and when I get back from erasing the board, then we'll look over this last contingent liability that we have in our selected problems. See you in just a minute. So author has picked a convoluted example. So since that's in our homework, I also made a convoluted example. But we want to, as a business, pay a bonus that is equal to 10% of net income after the bonus, right? So I've got to do a little bit of harder math. So we expect net income to be $165,000. So I want a bonus of 10% of net income once I have taken 1 plus the bonus percentage. So we want a 10% bonus. So please, when we do this, right, we take 1 and make this 10% in decimal format. This becomes 1.1. Okay? And I take 10% of net income. So let's take 10% of, so that's 0.1 times net income of 165, is what we're estimating. So when I do this, and here's my other calculator, and I take 10% of 165,000, we're going to come up with 16,500. And when I divide this by 1.1, I'm going to get a $15,000 bonus. So let's double check that. It says I want to pay 10% bonus on net income after you subtracted the bonus from net income. So we calculated this to be $15,000. Originally net income was $165,000. First it says take out the bonus because we only want to pay 10% on after bonus. So that'll give us $150,000. And then it says, well, after the bonus, you'll get 10%. So if we take 10% of $150,000, this is where we get the $15,000. This does work out. All right. But it is quite convoluted. So at this point, I'm probably going to have some type of, it wants us to book, it's probable, and I can estimate it. I would debit some type of bonus or wage expense of $15,000. Like that looked like $15,000. And then we've got bonus payable of $15,000 as well. And then we have booked that last contingent liability. And now all we have, believe it or not, are ratios. We've got one ratio. And I made this for one of my, of course, we teachers never have favorite students, never. But this was based on one of my very favorite students. When I moved to the West Coast. Y'all have different meat. I had never heard of a tri-tip before I came here. You've got different sports. You've got different everything. We don't have these things. And one of the things that I didn't have or didn't know as a sport was water polo. And so I get to my new university out here at the West Coast, it's got a pool, and I get in the pool, and after a while, one of my students, who I know is a water polo player, I realized that when I go there are all these women on the other end of the pool, and they've cut off half my laps, and I'm leans, and I'm like, finally I asked Alex, what are all those girls doing over there? How come they're taking up, this is prime swimming time, they're taking up my laps. And he's like, that's the women's water polo team. And I didn't even know much about water polo, and I certainly didn't know that women played it too. But in this case, we had really good teams, and in fact, at the time, this team was ranked #1 in NCAA. And in fact, Alex went on to play for the U.S. Olympics on the Olympics team. One of the other players who I also came to love, just because I spent half the time at the pool, was Balaj, and Balaj ended up playing for Hungary. So it was really nice to see some of our players play in the Olympics. But I had him for two semesters, for financial and managerial. And then he was always lifeguard when I went to go swim. So he was fun to tease. But he has, believe it or not, a water polo supplies company. And we have an income statement for the year, and we want to know what is over times interest earned ratio. So this is about current liabilities, this chapter, things that are due within the year, and interest, right? Regardless of how profitable I am on paper, if I can't pay my creditors, they will put me into bankruptcy, and I won't be making widgets or whatever it is that I make. So it's very important that I pay my debts, and if I have debts that involve interest, it's very important that I can pay my interest. So times interest earned is how many times could you have paid your interest that you have on your financial statements that relates to your debt? How many times could your net income have covered it? All right, times interest earned. So the best answer is as many times as possible, right? We want our times interest earned ratio to be as high as possible. So times interest earned equals EBIT divided by interest expense, because I want to know how many times it would have covered my interest expense. And you say, well, what the heck is EBIT? EBIT is another very common name, but it stands for earnings before interest and taxes. EBIT. So when I look at Alex's income statement, I see that net income is $440,000. That's earnings, right? And then the interest that Alex had was $10,000, and then the taxes he paid were $50,000. So this gives me an EBIT, right, of $500,000. And I divide by interest expense 10,000, and this gives me 50 times. Alex could have paid his interest on his debt 50 times with the amount of earnings before interest and taxes that he had. This is significantly good. We start to worry about a company that has a very low EBIT, because not only can they almost not pay their interest, if any of their principal was due on any of their debt, there was a chance they wouldn't be able to pay it, and therefore they would go into bankruptcy. And then I don't have to worry about the long-term debt, because liquidity is, can I pay my short-term debt? Solvency is, can I pay my long-term debt? I don't have to worry about solvency if I can't even pay my current debts. Okay, so that's chapter 11. You're going to go get a snack, come back, and we are going to look at chapter 12, which are long-term liabilities. See you in just a few.